Hello investors and welcome to the first week of 2019. Somebody on this chart is not making our list. Let's go swim with the sharks and find out who that is. Hello investors and welcome to the first weekly analysis by Shark Investments for 2019. Those of you that have seen my introductory video will recognize the format of this spreadsheet. This is the summary of the companies that were listed in the latest issue of the Value Line Investment Survey, my primary data source. And you will also understand the 6 criteria that I'm going to refer to throughout this video. However, for the help of those who haven't had the chance to see my introductory video, we're going to go right into a quick introduction on the criteria that I use. Now, if you want to get more detail, please go look at my introduction video. It has greater explanations of why these criteria are used, where the data comes from, the analysis process. So I look at 3 primary things: cash flow, earnings, and dividends. I break each one out into 2 criteria. So cash flow 0 means that a company has had 17 years of increasing cash flow per share per year. As CF1 means that they have had 17 years of increasing cash flow per share with 1 negative or flat year. E0, earnings 0, indicates increasing earnings per share for 17 years. An E1 is 17 years of increasing earnings per share with 1 negative or flat year. A dividend 0 is 17 years of increasing dividends per share, and a Div 1 is 17 years of increasing dividends per share with 1 flat year. No negative years are allowed. Again, my primary data source is the Value Line Investment Survey. It's available in hard copy and online at valueline.com. The investment survey has a lot of great proprietary analysis in addition to the historic numbers. I will not discuss any of the proprietary information here, but I highly encourage serious investors to go take a look at valueline.com and see if subscribing to any of their products is worthwhile for you. So this summary chart that is similar to what I used in my introduction generated some immediate feedback to me. Folks who used laptops or tablets had a hard time seeing the numbers. So what I'm going to do is I'm going to go company by company through tabs where I have enlarged the font size, and hopefully this will make it much easier for those of you who use smaller devices to see the data. Please give me your feedback in the comments section below and let me know if this is working better for you. If you have suggestions on how to improve it, make those as well. So starting out with Emerson Electric. Now, I go alphabetically through the sectors. So the listing is not indicative of any ranking system. It's purely alphabetic. Emerson Electric EMR, their dividend yield is 3.4%. It is filled with gold because it is greater than 2.5%, which is the benchmark that I use when I first started this. The Dow Jones Industrial Average yield was 2.5. I'll take a look at it every now and then, see if I want to make some changes, but right now we're using 2.5% as the benchmark. You can see that they were not qualified in cash flow or earnings per share, but they are a Div 0, meaning they had 17 years of increasing dividends per share. And you can see that very easily in the Excel, all increasing numbers. Now the other thing that Excel lets us do is satisfy one of our human elements, and that is that we like to see pictures, not just straight numbers. So here you can see the cash flow, earnings, and dividend per share trends. They are all generally up, but here you can see the zigzag shows us that they had some negative years with the cash flow per share and the earnings per share, but dividends per share was pretty much on a positive trend with no negative zigzags in there. This becomes even clearer when we look at the year-to-year change. And here you can see that from 2002 to 2003, cash flow per share, earnings per share were negative, but the dividends per share was positive. Well, you can almost see that little gold line there. 2003 to 2004, all three criteria were positive. They remained positive all the way out to the 2008 to 2009 when cash flow and earnings per share went negative, and the dividends per share remained positive. Now remember, that's the year-to-year change. So EMR makes our list with a 3.4% dividend as a Div 0. Next up, Franklin Electric. They're at 1.2% yield. They are a Div 1, and you can very clearly see here their flat year was from 2008 to 2009. If you look at the long-term trends, that dividend per share line is almost a straight line in the up direction. And you can see the zigzags here where they had some negatives. And that becomes much clearer when we look at the year-to-year changes. So all positive out here until we get to the 06 to 07 point where you have their first set of negatives. Then you have some more negatives dropping them out on the cash flow or the earnings, but they remain positive for dividend per year. W.W. Grainger, ticker symbol GWW. That can get confusing when you put it into your list and you're trying to find it because it is under G or W. I'm not sure why they do it like that. Anyway, they are throwing off 1.9% and they are a Div 0. Again, 17 years of increasing dividends per share, but cash flow and earnings per share didn't make the grade. And here we can see those trend lines tell us that. Nice, clean, smooth increasing line for dividends per share. Not the same for cash flow and earnings per share, but still an uptrend. And this is what it looks like on the year-to-year changes. And you can very cleanly see the gold bars on top of the zero line every year for the 17 years. Amphenol Corporation, still in the electrical equipment business here, 1.1%. Amphenol makes our list as a CF1 cash flow and an earnings per share E1. You can see their negative years here. They didn't start paying dividends for a while, and then when they did, they've been pretty flat. So they're not much in the way of income for those who are looking at income portfolios, but they might make the list for other investment portfolio types. Here you can see pretty good uptrends with one exception there. And this chart makes it very clear in the year-to-year differences that 08 to 09 they took a hit there, but I think a lot of companies took a hit in 08 to 09, so that's pretty understandable. Harris Corporation, I'm sure a lot of you know that name, Harris. 1.9% dividend yield, and they are an E1 and a Div 0. And we can see what that looks like in the trend analysis, generally up here. Here's where they took hit cash flow. Here's that negative year for the earnings, but the dividend per share continued on a positive trend for the 17 years. And that's what that looks like in the year-to-year analysis. Gold bar is always above the zero line. Cash flow, a couple hits here in the 13 out through 15. A little recovery in 16 and then another hit in 17. So Harris Corporation. Next up, Maxim Integrated Products. Now we've changed industries. We're in the semiconductor industry. Yes, a company in the semiconductor business is making our list, and for dividends, a Div 1. Here was their one flat year here. Notice that it was 09 to 010, so again, that was kind of a rough time in business. but they're throwing off 3.5% in their yield. So for income investors, this might be something worth looking at, especially if you want to diversify into some other good dividend payers. Now, take a look at this chart. Can you just imagine what it must have been like in the boardrooms and some of the staff meetings when people saw the earnings per share go below what they were paying out in dividends per share? Yep, I'm sure that was some fun conversations to be had. And here's what that looks like on the year-to-year change. Here's those negative years, and then the rest of the time. But the dividends were always in the positive category. Another member of the, well, okay, that's supposed to be semiconductor industry, not semiconductor or industry. Microchip Technologies, MCHP, they're at 2.1%. There's their one flat year going from 14 to 15. So they're a Div 1. And that's what they look like. Again, must have been some interesting board meetings here in this time frame. And here's what the year-over-year changes look like. Big Blue, IBM. I have to admit, when I first saw IBM make the list, I was kind of surprised. But as I went back and thought about it and read some more about Big Blue and stuff, you kind of think, well, they do a lot of good efforts to grow their own leadership, to stick to the IBM way. They may not make changes necessarily fast, but they have a good, consistent performance. So IBM, they're paying 5.6% in their dividend yield. That's nothing to sneeze at. And it's a Div 0. So you can really take away from this that IBM is interested in taking care of their shareholders. We see what this looks like on the trend line. Things were going pretty well up here to 14, and then they started off a little bit. Dividends keep going strong, and this becomes really clear on the year-to-year change analysis. Pretty good numbers in here, but look at this, 14 to 15. Boy, it drops down, then it starts recovering again. I'll tell you what, anybody watching this that understands IBM, that has been researching IBM, if you want to drop a line in the comments section and explain what happened here, I'm sure there'd be a lot of folks that would be interested in understanding that. I'm giving some thought to putting IBM into my portfolio, so I'd certainly appreciate it. Save me some time as I go in and do my due diligence and research before I make my investment decision. And this brings us to a really good point as we get to our summary slide here. Just because a company has made our list does not mean that it's an automatic go out and buy shares. What it means is you should give it further consideration to be on your list, to be in your portfolio. This summary sheet shows us that out of the 130 or so companies that were in issue 7, only 8 made our list of quality companies for further consideration. 3 of those companies had pretty good dividend yields for those of us who are income investors. There's a couple here that could fit some other investment methodologies. And as I promised, I will look at companies that are not qualified but are names of interest each week. So we're going to take a quick look at Intel, Apple, and Western Digital. Now to do that, we're going to go back to our summary chart. I'm going to have to play around with this one some in future videos because I recognize that this may be hard for some folks to see. But we're going to start out with Intel. Intel is throwing off 2.5%, so they are right at that average. So that's not too bad. We all know they're in the computer and peripherals sector. But what's interesting about Intel is if you go over here to the right, you'll see that they're not qualified in dividends per share with number 2. So what that means is that they had 2 flat years. And if you look, their first flat year was going from '02 to '03. Now the reason why that's important to us is because in a year we will be looking at the 17-year period that starts in '03 and goes to 2020. So that means that Intel could become a Div 1 on our list. So we may want to start looking at Intel now. Apple, throwing off 1.9%, is in a similar situation, but for cash flow. So here you see that they would be what we might call a CF2. They've had 2 negative years, one of them out here in 16. But look at this: in '02 to '03 was their first negative year. So next year, when we're looking at the '03 to 2020 time frame, Apple could become a CF1 and therefore make our list. Now this next company, Western Digital, they're probably not going to make our list anytime soon. Look at these numbers: 6, 8, 13. But what's interesting about Western Digital, they have a 5.2% yield, so that's going to grab someone's attention on the income side. Now the thing you got to think about though is, look, they didn't pay dividends for a long time, all the way up until 2013, and then when they did pay the dividends, well, out here from 16 all the way through 19, they haven't increased them. So they're not on my list. I'm not going to spend any time looking at them, even though they have a nice yield. But for some of you income investors, you may be more willing to take the risk on them and say, well, you know what, even if they're not increasing their yield, 5.2 still is pretty good numbers, and you may want to dig into them a little further to add to your portfolio. So as we wrap up this first week of our investments, a couple of things that I want to emphasize. First of all, I am not a certified investment manager counselor. I'm not a certified financial counselor. I do this analysis every week for me, and I want to give back to the community that's out there, so I share what I learn. You use that data however you see fit, and I hope that it will help you to make some good decisions. Again, I want to emphasize, just because a company is on our list doesn't mean it's an automatic investment. It just means it's worth taking the time to dig into a little bit more. I'd like to ask everyone that watches the channel to please leave me some comments, either comments on the specific companies that we've discussed, or comments on how I can make this channel better, whether it's the mechanical view or the way the data is presented or the charts, whatever I can do to try to help make this a more interesting experience for all of us. Now, I did get some feedback from some folks that already have said, well, why don't you put a camera on yourself and record yourself talking? This channel is all about the numbers. I don't think you need to see me talking. It's about the numbers. But let me know what you think about that. If seeing my ugly mug on the video is going to make it more interesting for you, then I'll give it some consideration. But I'd prefer to keep it all about the numbers. Everybody out there, have a great investing week. I hope you make some great decisions during the week. And I look forward to all the comments that folks will leave. And we will see you all next week.